Welcome back to Success with Steven. My name is Steven Smith. On this channel, we discuss all things financial literacy. If you've been told no because your credit score wasn't perfect, your business was too new, or you didn't have years of tax returns ready to hand over, then this video is absolutely for you. Today, we're not talking about traditional banks. We're going to actually bypass that, and we're talking about lenders and funding sources that approve far more people than banks ever will. Today, we're talking about fintech lenders. Now, these are some of the same tools that thousands of business owners use every single day to fund operations, to cover expenses, to scale faster, and to survive when banks say no. And yes, bad credit will be allowed in many of these cases. So without further ado, let's get right into the video. Now, we've discussed fintech companies before, but let's briefly review this topic once again. Fintech is short for financial technology company. Now, these are organizations that use technology to provide innovative financial services, making them more efficient, accessible, and often cheaper than traditional banks. For clarification, these are not banks in the traditional sense. These are tech companies that partner with a bank to provide financial products using software automation and data instead of human-driven underwriting. Traditional banks rely on rigid underwriting guidelines, manual reviews, and conservative risk models. Fintech lenders rely on data, algorithms, and speed, and that difference alone is why fintech lenders approve more borrowers than traditional banks ever will. That speed is not just convenient, it's also strategic. It allows business owners to access capital when they actually need it, and not months or years later when the opportunity is already gone. However, there's always going to be a trade-off. Now, fintech lenders, they are easier for you to qualify for, but the capital will be more expensive. That's just the reality, and anyone who tells you otherwise is just not being honest with you. When traditional banks lend money, they can afford to charge lower interest rates because their cost of capital is lower. Fintech lenders are lending investor money. Investors expect returns, and that return comes with higher interest rates and shorter repayment terms. With traditional banks, you might see interest rates tied closely to the prime rate, often in the range of prime plus 1 to 6%, depending on whether or not that line of credit or that loan is secured or it's unsecured. With fintech lenders, interest rates commonly range from 10% on the low end to well over 20% on the higher end. Now, that sounds scary if you don't understand how to use these products correctly, but for many businesses, access to capital is far more important than the cost in the short term. The key is understanding when fintech funding makes sense and how to use it strategically. Most businesses don't choose fintech lenders because they want to pay higher interest. They choose fintech lenders because they have no other choice or because speed matters more than cost. Many business owners get denied by banks due to a lack of profitability on paper, maybe insufficient time in business, missing documentation, or personal credit issues, or others simply cannot wait for an approval. Fintech lenders will fill that gap. They care far less about your story and far more about your revenue. If your business is generating consistent income, then fintech lenders are willing to take that risk on you even if your credit profile is not perfect. That alone will open the door for thousands of business owners who would otherwise be locked out of funding. One of the biggest advantages of fintech lenders is how little time in business they require. While banks typically want to see 2 or more years of operating history, most fintech lenders are comfortable approving a business with as little as 6 to 12 months of history. Revenue will always matter more than age, and most fintech lenders want to see a minimum of $10,000 per month in gross revenue, and that revenue needs to be consistent, not a one-time spike. So if you have a business that's producing revenue and you're depositing money into a business bank account regularly, then you're already meeting the requirements that you need to qualify for fintech lending. Now, that is the reason why fintech funding is not ideal for pre-revenue startups. So if you're not making money yet, this is not the lane that you want to be in, but if you're already generating income and you just need capital to grow, then fintech lenders can be extremely powerful for you. There are ways to manufacture cash flow. I've talked about this in many videos. However, I do want to give a disclaimer with this. If you are currently not making money, it does not make sense for you to fake or manufacture the income that your business is currently producing to get higher limit funding, because you are going to be borrowing at a higher interest rate. If you are currently not making money, chances are it will not end well. That is my disclaimer for you. I don't recommend it. Now, in our next section, we'll talk about fintech lenders and and I'll show you how they separate themselves from banks. Traditional banks want strong personal credit, often 700 or higher. Fintech lenders are far more flexible. Many fintech lenders will approve borrowers with credit scores in the low 500s or even low 600s. Some are even more flexible depending on your revenue strength. Now, that doesn't mean your personal credit no longer matters. Your credit can still influence which lenders will qualify you, how much you're approved for, and the interest rate and the repayment terms that you receive. So even when revenue is doing most of the heavy lifting, improving your personal credit even just a little bit can help you access better options and less expensive funding. And this is where a platform like Rising may be helpful. Now, Rising is a DIY credit improvement platform that gives you access to your credit reports and scores and helps you identify information that may be negatively impacting your credit and provides you with tools that help you take action. You can create custom dispute templates, you can track responses from the credit bureaus, and you can use the auto mail feature to send your disputes directly through the Rising website or the app without having to print letters or purchase postage stamps or anything like that. Rising also includes the ability to report up to 24 months of qualifying rent and utility payment history, and that can help add 24 months, that's 2 years of on-time payment history to your credit profile instantly. It's also very easy to get started. Once you are signed up, you can actually go to the how-to tutorial that will show you how to use Rising in about 7 minutes or less. So even though fintech lenders may be willing to work with imperfect credit, you should still work on strengthening your credit while you build your business revenue. The combination of stronger personal credit and consistent business cash flow, it can put you in a much better position when it's time to apply for traditional bank funding later. Right now, you can access Rising through the $1 7-day trial. I'll leave a link in the description. There will also be a clickable link right here on screen. Now, getting back to fintech lenders, this is still where bad credit may stop being an automatic deal breaker. Instead of asking for multiple years of tax returns, detailed profit and loss statements, long-term financial projections, fintech lenders focus heavily on your business bank account. Most of them require a secure read-only connection to your business bank account, and this allows the lender to quickly review your deposits, your average balances, your cash flow patterns, and your overall revenue consistency. This is one of the main reasons they can make funding decisions very quickly. Some fintech lenders will also allow you to upload bank statements manually if you don't want to connect your account. However, many prefer a direct read-only connection because it allows them to verify the information and process your application much faster. The first fintech business line of credit I want to start with is Fundbox. Now, this is often the entry point for business owners who cannot qualify with a traditional bank. Fundbox was built to solve that problem. It's a financial technology company that focuses on giving small business owners faster, more flexible access to working capital. Since 2013, Fundbox has connected hundreds of thousands of small business owners and helped owners access funding when banks would normally say no. The application process is entirely online. It requires no traditional paperwork, and decisions can be made in minutes instead of weeks. Applying doesn't impact your credit score, and if you are approved, your funds will be deposited as soon as the next business day. To qualify, your business must be based in the US, you must have a business checking account, you must be operating for at least 6 months and generate at least $30,000 in annual revenue. And that breaks down to roughly $2,500 per month, but I recommend that you have at least $10,000 to, let's say, $20,000 in your business bank account, and you should have continuous revenue going into that account for at least 90 days. On the credit side, Fundbox will typically look for a personal FICO credit score around 600 or higher, which makes it accessible to business owners with fair or less than perfect credit. And that's exactly why Fundbox earns the first spot on this list. It's designed for real businesses with real revenue, not just perfect credit profiles, and it serves as a strong starting point in fintech lending. The second fintech business line of credit on our list is going to be Bluevine, and this is where many business owners step it up a little bit if they need larger credit limits and more flexibility than entry-level fintech options. Bluevine is a well-known financial technology company that specializes in revolving business lines of credit. The application process is fully online and takes just minutes to complete. Now, Bluevine will use automated underwriting underwriting, which allows many applicants to receive a decision in as little as 5 minutes. Applying doesn't impact your credit score at the initial stage, and if approved, funds can be accessed quickly. Sometimes it can be the same or next business day, especially if you use a Bluevine business checking account. To qualify for a Bluevine line of credit, your business generally needs to have been operating for at least 12 months and generates at least $10,000 in monthly revenue. Bluevine typically looks for a personal FICO credit score of around 625 or higher, which is still far more flexible than most traditional banks. Your business must be properly registered in the US. It needs to be in good standing and have an active business checking account that Bluevine can review for cash flow activity. There are some states where Bluevine may not be available, and if you want to see a full breakdown of Bluevine, I'm going to link my review video right here. Bluevine earns its spot on this list because it balances speed, flexibility, and higher funding potential. For business owners with steady revenue and fair credit who are ready to move beyond starter fintech lenders, Bluevine is often the next logical step. The third fintech business line of credit on our list will be OnDeck, and this is one of the most established names in the online business lending space. OnDeck has been around for years and is known for offering fast access to working capital for businesses that may not qualify with traditional banks. The application process is handled almost entirely online, and many business owners receive a decision within minutes. OnDeck is a good fit for businesses that are a little more established and looking for higher funding potential compared to entry-level fintech lenders. While approval is still much easier than a traditional bank, OnDeck does expect to see a track record. To qualify for an OnDeck line of credit, your business generally needs to have been operating for at least 1 year and generate around $100,000 or more in annual revenue. OnDeck normally looks for a personal FICO credit score in the low to mid 600s, which keeps it accessible for business owners with fair or decent credit. You'll also need to activate a business checking account so OnDeck can review your cash flow and manage repayments. OnDeck earns its spot on this list because it'll bridge the gap between fast fintech funding and more bank-like credit limits. For business owners with steady revenue and average credit who need reliable access to working capital, OnDeck is often a strong third step in the fintech funding strategy. The fourth fintech business line of credit on our list is Fora Financial. Fora Financial has been funding small businesses for years and will focus on revenue-based approvals rather than just having a perfect credit profile. The application process is online only, and it's also designed to move very quickly. There are many businesses that receive a decision within hours and funding shortly after approval. This makes Fora Financial a strong option for owners who need capital to cover payroll, inventory, marketing, or short-term cash flow gaps without waiting weeks for a bank response. To qualify, your business generally needs to be operating for at least 6 months and shows consistent revenue. Fora Financial will normally look for a business generating solid monthly sales around $20,000 per month and is known for being more flexible with credit, often approving owners with personal credit scores in the 500s. An active business checking account and recent bank statements are required so the lender can review your cash flow. Fora Financial earns its place on this list because it'll prioritize speed and accessibility. So if you're a business owner with steady revenue and less than perfect credit and you need funding quickly, this can be a practical fourth option in the fintech funding strategy. The fifth fintech business line of credit on our list is Biz2 Credit, and this option is geared toward business owners who have steady revenue and are ready for a larger credit limit than entry-level fintech lenders. Biz2 Credit operates as an online lending platform that connects businesses to revolving lines of credit designed for cash flow management, inventory purchases, payroll, and growth expenses. To qualify for a Biz2 Credit line of credit, your business generally needs to have been operating for at least 12 months and show consistent revenue of around $20,000 per month. Biz2 Credit normally looks for a personal credit score in the mid 600s or higher, and it does require recent bank statements so it can evaluate your cash flow and your overall financial health. I have an entire video on Biz2 Credit showing you my experience when I qualified for one of their business loans. I highly recommend you watch that video. I'm going to link it right here. Biz2 Credit earns its place on this list because it sits at the higher end of the fintech spectrum. For business owners with solid revenue and fair to good credit who want access to larger revolving lines of credit without going through a traditional bank, Biz2 Credit can be a strong fifth option in a fintech funding strategy. The sixth and final fintech business line of credit on our list is going to be OneWest. OneWest is a digital small business financing marketplace that connects owners to flexible funding options through its automated lending engine. So rather than functioning as a single lender, OneWest platform will match your business with multiple loan partners in its network, giving you choices and helping you find financing that fits your cash flow needs. The application process is online, it's fast, and it is designed to save you time compared to going with a traditional bank. Most businesses can receive approval decisions in 48 hours. It just depends on the lender that you get paired with. To qualify for a line of credit through OneWest, your business generally needs to have been operating for at least 3 months and show consistent cash flow with at least $10,000 in gross monthly sales. OneWest can work with business owners who have lower personal credit scores, sometimes in the 500 range, depending on which lender and network that you're currently matched with. An active business bank account and recent bank statements will still be required, so that way they can assess your revenue patterns. OneWest earns its place on this list because of its combination of speed, accessibility, and because you're able to access multiple different lines of credit options all at one time. For companies with fair credit and steady revenue that want flexible revolving funding without the strict hurdles of a bank, OneWest is a strong option, and it's the final option in this fintech lineup. I want to thank you guys so much for watching this video. If your credit is not where you need it to be yet, that doesn't mean that you stop moving forward. Fintech funding can bridge the gap while you repair your credit. That is how real businesses grow. They don't wait for perfection, they improve while they move forward. The key is knowing which tools to actually use. So once again, if you need to improve your credit, check out Rising. You can sign up today for $1. And if you found value in this video, please make sure that you like and subscribe to the channel. Make sure that you turn on notifications. This channel is all about accessing funding, understanding credit, and building real financial leverage. And as always, thank you guys so much for watching this video, and you have a wonderful day.